What do you do in a day like today?
You try to keep your emotions in check, okay? Obviously, we're dealing with the unknown unknowns now. But what we would say to people is you sort of have to step back and look at a couple things here. Number one, although the employment data is meaningless in the moment, it's actually significant because if you think about it, we have to deal with the situation at hand, but it's a positive that we're coming into this situation, the coronavirus, at essentially the point of maximum economic strength. Think about it. I think a lot of people, if you go back to the trade war in 2018, were surprised that a trade war didn't cause a sharp economic downturn because that was the kind of situation it could have been. The reason it was is because the underlying strength of the economy was as it was. Second thing is, for us, the tenor of the trading is different this week versus last week. Last week, we really saw very much indiscriminate selling getting out of longs. This week, we're seeing a lot more degrossing, basically taking shorts down along with longs, which was very similar to the kind of activity that we saw in December 2018 towards the end of that market meltdown. But really, for us, the other thing we're looking at is any change in the weekly jobless claims and the credit markets. We see signs of stress in the credit markets. We don't see the kinds of stress that we saw, say, in the first quarter of 2018, but that's how we take temperature. But the most important thing for an investor is to, basically retain control over what would normally be, an emotional situation.
Julian, this is Lara, and I hear what you're saying. I think for all of us, when we look at the screens and they're just red, I think it truly is one of the hardest things to do when you're seeing a week like this. And I see volatility continuing to spike. We have the VIX today higher than it had been really at any time so far during this period of uncertainty. Where does that top out?
Well, so if you look at it over the course of history, basically you are at levels that you've seen only on a number of occasions. You saw that, in Volmageddon in early 2018. You saw it during the China FX crisis in August of 2015, both of which were short-term events. The only other two comparable periods are the depth of the financial crisis, where volatility was much higher, and the crash of 1987. And I think, you have to sort of step back and ask yourself, are those events likely to occur? We would say that the answer is likely no, because factually, the banking system is in a much, much better shape in general. The Fed has clearly, pledged its commitment to provide liquidity, essentially a whatever it takes type situation. And, we don't see the valuation excesses that we saw in 1987 comparably. And again, at the end of the day, assuming, and I think that this is sort of the rational assumption, that you're going to get through the virus in 1, 2, or perhaps 3 quarters, what you're left with are yields, well below 1% on the 10-year, and record money market balances and money going in to bond funds over $1 trillion over the last 5 years, all sources of liquidity, with a consumer that has remained buoyant despite stresses over the years.